This video covers the dividend discount model, and it's usually the first stock valuation model presented to students in finance. And it's done for a reason. It sets the foundation for the other valuation methods and models that we're going to look at. And so this serves as the introductory video for it. So before you watch those other videos, you should be watching this video to get the context and the background for how valuation models of stock work in general. Not only will we be discussing the dividend discount model, but we'll also be unpacking concepts such as growth and sustainable growth in the process. And so remember what we said way back in a previous video. We said that the value of any financial asset is the present value of its future cash flows. And that holds true for value in common stock. Common stock is a financial asset. And so what that means is we need to figure out the cash flow to the stock, and we need to figure out a discount rate, and we'll call it RS. And so what are the cash flows, and how do you compute the discount rate for common stock? That's what this video is all about. So before we go further, let's actually draw a timeline so we can see what's going on here. So first thing you notice is we start off at time 0 like we always do. We have year 1, 2, and 3, and we go all the way out to infinity. And why infinity? Because a common stock never matures. Corporation exists forever. And so we have this infinity sign. We'll deal with this infinity sign in a few minutes because you can't operationally use this model the way I'm presenting it when you have an infinity sign, because then you'd have to calculate dividends, which is what the cash flow of a common stock is, all the way out forever. And you'd have a spreadsheet with an infinite number of rows trying to do this. So we got to get rid of the infinity sign. We'll do that in a minute. But let's continue here with this timeline. First off, we're going to have a dividend that's known right here. It's called to be labeled D subscript 0. It's the dividend just before today. It was paid to shareholders just before today. So if you buy the stock right here at time 0, you don't have access to that dividend. You're not going to get the dividend. The next dividend that you will get will be D subscript 1, 1 year from now. And that'll be paid just seconds before year 1 ends. And then we'll have, in 2 years, we'll get paid a dividend D2. And in 3 years, we'll get D3. Now notice, I'm putting subscripts on the Ds, which is a little different than what we did with bonds. If you remember when we did bonds, we looked at coupon payments, right? The cash flow to a bond, and we calculated its present value. We didn't put any subscripts on the Cs, the coupon payments, because the coupon payments were fixed. They were fixed income securities. Bonds are fixed income securities. So there was no subscripts. All the Cs were the same. But here, the subscripts are telling you that the dividend is changing, or is subject to change. It can change, because the board of directors decide on the amount of the dividend and whether or not it grows. So that's the reason why we're seeing these subscripts here on the Ds. And the way to calculate these Ds is to assume a constant growth rate into the future. Assuming a constant growth rate makes the model much easier to work with. A little later on, we'll look at varying the growth rate of dividends. So we assume a constant growth rate, and here's how it works. Let's assume that D subscript 0 is $1. We want to know, well, what is this dividend 1 year from now? Well, we need a growth rate. So let's say, again, let's mark it down here. D subscript 0 is $1. Let's assume a growth rate of 4% in dividends. That means, look, the company is growing reasonably well, and as its earnings grow, the company pays out a percentage of its earnings in terms of dividends as a payout ratio. And so that's what dividends represent. They represent payments from the earnings of the company. And if the earnings of the company are growing at 4%, well, so can the dividends. And so the board of directors, we're assuming, will make that 4% increase in the dividend. They'll declare a dividend that's 4% bigger on average. And so what we want to do now is get back to calculating D subscript 1. So D subscript 0 is the dividend we get right here that we know, because we can observe it. You know what the dividend is of the company the dividend that's been just paid from the company. That's knowable. And then we grow it by 1 plus G, and that's D1. And so this is $1 times 1.04. So the dividend next period is $1.04. This is $1.04. And we do the same thing to get D subscript 2. We just take the dividend again at time 0, grow it 2 periods, and this will be $1.816. Okay, so what we're doing is we're growing this for $1.04. We're growing it 4%. We get 1.0816, and so on. We just keep doing that. That's how dividends grow in this model, where we have constant growth. Now, where does that growth come from? When we have growth that goes all the way out to infinity, we call it a special name. It's called sustainable growth. And so let me unpack and develop this concept of sustainable growth off to the side here, independent of the problem I just showed you. And the formula for sustainable growth is 1 minus the payout ratio times the return on equity of the firm. And so you look at that as like, well, that's kind of strange. Why is that sustainable growth? First off, remember the sustainable growth is growth forever. It's sustainable. And this 1 minus the payout ratio, and by the way, the payout ratio here is your dividends per share divided by your earnings per share. So if you have a $2 amount in earnings, your earnings this year are $2, and you pay 50 cents out in terms of a dividend, that means 1/4 or 25% payout ratio, 0.25 is your payout ratio. Well, if you're paying out 25% of your earnings in a dividend, that means you're retaining, that's what this guy is right here, retained earnings. These are earnings that you're retaining, you're keeping, and you're paying out 50 cents, 25%, you're keeping 75% here. So this would be 0.75, 1 minus the 0.25 is 0.75. And then you're going to multiply it by the return on equity for the company, and let's assume that's 10%. So therefore, your growth rate would be, in just this numbers I'm making up, would be 7.5%. That's a bit of a high sustainable growth rate. You know, most companies, on average, over a long period of time, don't grow at 7.5%. I mean, they may grow for a period of time at 7.5% or more, but they can't grow forever at 7.5% because they'd be growing faster than the economy. And if you grow out forever and you grow forever into infinity, that company will take over the entire economy eventually. So it doesn't quite make sense. That's why we have this concept of sustainable growth. It means reasonable growth that's below the level of the economy. The economy grows at, ballpark 3.5%, 4%, maybe a bit more. Sometimes it's higher, sometimes it's lower, but that's about how it grows on average. So we assume that that's the maximal sustainable growth rate of the economy. And for any business that's in the economy, it has to be equal to or a little bit less. Otherwise, that business, which is much smaller than the economy now, will eventually outgrow the overall economy and take over the world, so to speak. So from that perspective, 7.5% is a bit high, but it's just for illustrative purposes. Let's look a little bit more closely at this sustainable growth rate because it looks a little weird and it looks a little foreign, but it's really not foreign at all. Here's my point, and I'll make it by way of an analogy. Let's assume that you put $100 in a bank account, and that bank account has an interest rate of 10%. And if you pull out all of your earnings each year, how much will that account grow? Well, according to what I just showed you, it's going to be G equals 1 minus the payout times return, I should just call it the return on your bank account. And so if you withdraw out of that account 100% of your earnings each year, the payout ratio is 1. So what do you retain is 1 minus 1, you retain nothing in that account. And so in terms of earnings. And so you multiply that by the 10%, and what's your growth rate? Your growth rate is going to be 0. And I should be careful about my decimal points here. Let me get rid of that. And so it's 0%. So this represents 10%. And so that's going to be 0% growth rate because you keep pulling out all your earnings. And so your account is going to stay at $100 forever if you keep pulling out all the earnings. Now, what happens if you don't pull out any of the earnings? Well, then your growth rate will be 1 minus the payout ratio of 0 times the 10%. That means your growth rate will be 10%. That's your maximum growth rate of your bank account. Right? It can grow 10%, or if you pull all the earnings out, it can grow to 0. So somewhere between 0 and 10% is what it can grow at. And what if you pull out half your money? Then the growth rate will be, when I say pull out half your money, I really mean pull out half of your earnings. It's going to be 1 minus 0.50 times the 10%, and that'll be 5%. Your account will grow at 5%. Well, businesses are the exact same way in the big picture of things because companies have a return on equity, right? Here's the return on equity formula, right? And we're assuming that's what the company is growing at. The company's equity, which is the stock, is growing at 10%. And the company has a choice. It can either pay a dividend and pull some of those earnings out, or not pay a dividend and reinvest all of it. So they have this decision on, how much the dividend will be is really a decision on how much they want to retain also. So what exactly do they do with that retained money? Well, as I said, they retain it and they reinvest it in the business. And the assumption is that that reinvested money earns the same rate of return as the rest of the company, the existing company, which is 10% here. And so companies can vary their growth rates considerably based on this math. So this is an interesting concept. This sustainable growth is an interesting formula because what it tells you is that, when you have small companies and they're growing really fast, because their businesses, when I say they're growing fast, their sales are growing fast, they have a hot product, then how do they maintain strong growth? Well, what they do is they don't pay a dividend. All their earnings get plowed back into the company, so their payout ratio is 0, which is exactly what you observe. You observe young companies having very low, if any, dividend at all because they're plowing it back in the company. And when companies become older and they're in more mature markets, they start paying dividends. And they pay dividends that grow slowly over time. And the slower the growth of the company, the higher the dividend often. And that's exactly what we observe in the real world. Older, more mature companies tend to pay a higher dividend, and that means their growth rate is lower. So the size of the dividend relative to earnings matters in common stock valuation. It matters in terms of the growth rate of the stock. So now let's move on to the other aspect of common stock valuation. And that is, the other aspect is the discount rate, RS. And so that is the discount rate for stock. And the way we're going to model that is, well, you've already seen it. It's going to be the risk-free rate of return plus the market risk premium, right, which is this, right? The return on the market minus the risk-free rate is the premium just for taking risk in the stock market times the beta of the stock. So we could put a little I here, IRS, I for individual stock I, and then S because it's a stock. And so what you have is, remember, you have this opportunity cost of money because when you invest in a stock, you're losing the interest rate in the bank account you pulled it out of. So that's what this RF stands for, this risk-free rate. And then when you put your money into stocks, well, this is the market risk premium for the average stock. And then you have a beta that's particular to your stock that gives you an adjustment for the amount of risk, systemic risk that your company has relative to the market. And so in today's world, just to make up numbers, if the risk-free rate's 1%, and we know the market returns, let's just say today it's at 10%, and then we subtract the 1, and let's say the beta of your company is 1.5, then what happens is this is going to be 1 plus 9 times 1.5, and this will be 14.5% will be the discount rate on your company, common stock. In other words, the discount rate for discounting the dividends is the required rate of return given the risk of the stock, and the risk is embedded right there in that formula for RS. RS is a required rate of return given the stock's risk. So now what we want to do is we have an idea. We have an idea now of where the cash flow is coming from, right? And we have an idea now how to calculate a discount rate. We have all the information we need to be able to value a stock. So again, let's draw it out here on a timeline. Start off at time 0. We're going to value it right here. The cash flow, which are dividends, goes out to infinity. And we're going to have a D subscript 0 here where the stock is, the dividend has just been paid. Then we get D1 that we're going to get if we buy the stock. We get this dividend in a year from now. We'll get this dividend in 2 years from now. And it just keeps going out to infinity. And what we're going to do is we're going to take these dividends, discount them all back, and calculate a sum. We're going to add them all up, and that will be the value of the stock. And that's what the constant dividend discount model is all about. Constant growth in between these periods is constant growth, and then it's a dividend model, and the dividends are discounted to their present values. So the value of any financial asset, including a common stock, is the present value of its future cash flows. As I said a few minutes ago, this guy right here is a problem because we can't operationalize this concept, this math. You can't actually use it when you have an infinity sign here. So how do you get rid of the infinity sign? Well, it's a little bit of a mathematical trick, but it boils down to something relatively simple. And this is what it boils down to. Put it in purple here. What we're doing is we're going to estimate a stock price, and the hat stands for an estimate, and P stands for the stock price at time 0. What is the price of the stock? What is the value of the stock today? It's going to equal D1, the dividend next period, this dividend right here, divided by the discount rate, RS, that we just looked at here, minus the growth rate. And so that's what it boils down to, a relatively simple formula. We got rid of the infinity sign, right? That's gone. And it's just, this is the formula. So this is the formula that most people are taught initially when they look at common stock valuation. It's like a benchmark model in a sense. And look, if we have the dividend here and we have a growth rate, we can figure out D subscript 0. It's just, what do you expect the dividend to be next year for the company? And then we come up with a discount rate, as I showed you, with the risk-free rate. And we come up, we estimated, say, a 10% market return. And we estimate a beta. We can get that right off the web, or we can compute it ourselves. And that's 1.5. We have the RS. We have a growth rate. So we have everything we need to value the stock. Now keep in mind, this formula and this model only works when RS is greater than G. You see that? Because if this wasn't the case, this denominator would be negative. That wouldn't make sense, because then you'd get a negative stock price, right? You don't have negative stock prices. So this model only works when the discount rate is greater than the growth rate. Okay. Now, before we go further, I tell you that you need a discount rate greater than the growth rate, but you want to ask, well, well, wait a second, why is that the case? And here's the thing. You need, in order to come down and collapse to what we call a finite stock price, it's not infinite. What we need is the dividends up here to be growing at a smaller rate than what you're discounting. In other words, you need to discount more than what it's growing by. Because if the dividend growth rate is higher than the discount rate and dividends go out in time to infinity, each one of these numbers gets bigger and bigger and bigger and bigger and bigger as we come down. And we get an infinite stock price. Okay? Not a negative stock price. So when you look at the math is tricky here because we boiled it down into this nice, neat formula. The math is tricky, and it only applies when the discount rate is higher than the growth rate. If the growth rate's too high, the stock price is not negative as the math here suggests. It's actually infinite because the stock price is growing so fast that you simply can't discount them fast enough. So that's just a caveat that we need to have a discount rate greater than the growth rate. So now we're in a position to do an example. So here's the example. Let's say the dividend just paid is $1 and that the growth rate is 4% forever, sustainable growth coming from this model. Let's say we estimated this, 1 minus the payout ratio times the ROE, and it could have been, I'm just making numbers up, that the return on equity is 10% and the payout ratio is 60%, so 60% of earnings are paid out, then you would get a 4% growth rate. This would be consistent with a 4% growth rate. Okay? And then we're going to assume, let's assume a discount rate, let's make it up 12%. And 12%, well, where could that come from? Again, it comes from the capital asset pricing model here. And we could come up with an estimate. Let me give you an example that's consistent. Risk-free rate's 1%. Return on the market that you require given the risk. Remember, that's what this is, the return given the risk. So we're capturing risk in this model, which is very important. And that's coming from the 12 minus the 1 times, let's just say the beta of this company is a beta of 1.0, for example. So this stock has the risk of an average stock in the market. And so the discount rate would be 12%. That would be an example that's consistent with this 12%. So now we have everything we need to figure out, well, what's an estimate of the stock price today? It's going to be the dividend next period. Now, we don't have the dividend next period, but we have all the information to calculate that dividend next period. It's going to be $1 times 1.04. So this will be $1.04 up top, and then we'll have the 12% minus the 4%. So notice G is smaller than the discount rate. And we do the calculations, we get the value of this stock is $13 per share, because this is the price per share. Okay, so that's the constant dividend discount model. Now the question becomes, what do you do when there's not constant growth? And, constant growth is just an assumption to make the math easy and the concepts here easy. But in the real world, growth is all over the map. And so what you find is you find companies growing really, really high rates for short periods of time. When I say short periods of time, in the scheme of things, short periods of time could be 15 years. That may seem like a long time, but remember, I'm comparing it against sustainable growth, which is growth out to infinity. And then the growth rate slowly comes down because competition moves in. If you have a strong growth rate, that means your stock price is high and your business is growing and earnings are growing. That means you're in a market that you somehow have some type of monopoly. When I say a type of monopoly, I mean that the firm has some control over its price. And when it has some control over its price, it usually has control over its profit margins and higher profit margins compared to a business that does not have control over its price because it's in a perfectly competitive market. when you're in a perfectly competitive market, you tend not to have very good profit margins. You're just squeaking by. So when a firm has a short-run burst of growth, something really good is going on in the business. And what people do in business is they steal it. So when they see high growth rates of companies, they try to reproduce the product or something close to it or compete somehow against it, and they eventually steal the growth of the business, a business that can't innovate. And that's typically how things work. And so you don't see companies growing for very long at really high growth rates. They tend to come down. And so let's look at a model where there is a variable growth rate. And so what we're going to do here is let's look at an example. It's sometimes called two-stage growth. And I'm not worried so much about the definition, but all it just means is there's two periods in which the firm grows, one at a high rate and then one at a low rate. So here's what we're going to assume. Let's start off with the dividend at $1. And we're going to say G1, the first growth rate, is going to be 20% for the first 5 years. Really high growth rate. And then competition's going to come in, and then eventually growth drops down to 3.5% from year 6 all the way on to infinity. And so how would you handle that? Well, that's not too difficult. Let me show you here. First off, let's draw a timeline, map it out. Gotta go out at least 6 periods. So this dividend right here was just paid at $1, and we know this is going to be $1.20 because we're going to compound it out at 20, and this will be multiplied by 1.20, and it'll be $1.44, $1.73, 207, 249, because it's 20% growth. 20%, 20%, 20%, 20%. It's a 7 there. Now, starting in year 6, right here, growth drops down to 3.5%. So multiply this by 1.035, and you get $2.58 right here for dividend in year 6, D subscript 0. Now look, we just estimated all of the cash flows. Okay, let's assume, I'm just going to make up now, I'm going to make up a number, RS, give you the 3.65, 13.65% or 0.1365. That's our discount rate. So given this information, we can value the stock, but we got to do it in pieces. We got to value it in components. And so here's what we're going to do. We got to get rid of this infinity sign. There's an infinity sign here. We got to get rid of it. And the way to get rid of it is, look, from here on over is constant growth. From year 5 all the way to infinity is constant growth. So if we take that dividend here of 258 that I calculated right here, and I divide it by the discount rate minus the growth rate to infinity, I can calculate a stock price at year 5. The stock price will be in year 5, $25.39. Okay? It's sometimes called a terminal value or sometimes called an horizon value. So what we're doing here is we're starting in year 6 right here. And we know starting in year 6 that the growth rate is 3.5% forever. The discount rate is going to be stuck at $13.65. We know what the dividend is next period, and we calculate this is the price in year 5. Now we got to discount that by the 13.65%. How many periods? 1, 2, 3, 4, 5 to the 5th power. And we do that, we get $13.39 for that terminal value. So what we just did is we chopped off infinity, and we calculated the value of the entire stock starting in year 5 all the way out. Now what we haven't done, and I'll do it in red here, is we need to take the present value of all these cash flows, these intervening cash flows, Okay, so we need to take the present value of this cash flow, this one, and this one. And when we do that, and we're going to discount each one by 13.65%, we're going to get $1.06 here. And the $1.06, let me write it down here. We're going to take 120, this dividend right here, discount it by 1.1365 to the 1 power. That's $1.06. Okay, so there we get $1.06. We're going to take the 144 here, discount it 2 periods, and we'll get $1.11, and we'll get $1.18, and we'll get $1.24 and $1.31. Notice what's happening here. The growth rate is 20%. It's higher than the discount rate of 13%. So what happens is, notice that present value of the dividends is actually growing. If we didn't assume a lower growth rate of just 3.5% for this second stage, then the stock price would be infinite, because we'd be calculating a present value of a dividend that keeps growing. That dividend, each dividend keeps getting bigger and bigger and bigger, and we'd have an infinite stock price. So to get rid of that infinite stock price and to get into reality, because there aren't infinite stock prices, we need to assume a lower growth rate eventually. And that's what we did. We just picked year 5. It could be year 4. It could be year 10. It could be 20 years from now that it drops down in terms of its growth rate. So you just have to make the assumption. I did the math here 5 years because I didn't want to go out 20 years and do all these calculations. It takes forever. So now, getting back to the story, the value of this company at this point is the terminal value going from year 5 to infinity, plus all the intervening dividends calculated back to their present value. And the value of this company is $19.29. Two-stage growth, sometimes called two-phase growth. And it's realistic. A lot of companies have really high growth rates, but they don't last forever. They eventually come down. And they have to come down, because if they don't come down, they're going to outgrow the economy. And so that's why we assume a lower growth rate eventually down the line. Now, let me review something we haven't covered with the constant dividend discount model. So with a constant dividend discount model, we had stock price, an estimate, equal to dividend next period divided by RS minus G. Now, what's interesting about this model is we can rearrange it and solve for RS. We solve for RS. What we do is, in order to solve for RS, we just put divide by 1. It doesn't do anything. Cross multiply, set them equal. D1 equals P subscript 0 RS minus G. Just basic algebra. Now, D1 equals P0 RS minus P0 G. And we want to solve for RS. And we solve for RS, we're going to get this. RS equals D1 over P0 plus G. Ooh, look at that formula. It says the required rate of return on the stock is equal to the dividend yield, that's the dividend yield, plus the growth rate of the dividend. And according to the problem that we looked at earlier, we had a problem where this was 12%, and we estimated a price of $13 and a growth rate of 4%, and we had a D1 of $1.04. So rewind back to that problem, and look what we have. The required rate of return, the components of the required rate of return is the dividend yield of 8% plus the 4% growth that you're getting. And there you have it. So what do you really see here? You see that a required rate of return is like a total return. It reflects the cash flow yield, which comes from dividends, plus the growth in capital gains. That's what G is. G is not just the dividend growth rate. It's also the increase in the stock price over time. Will the stock price really grow at 4%? Let's check it out. Let's go 1 year ahead. So if we go 1 year ahead, this is still going to be 12%. The required rate of return will always be 12% per year. The growth rate will always be 4% growth. Remember, we assumed it to be constant. The dividend here, this will be $1.04 times 1.04. Remember, the growth rate was 4%, right? Right here, that's the growth rate. This will be 0.0816. $1.08 and change. And so we have P subscript 1 here, the stock price 1 period from now. And so what will P be? Well, take a look at this. This is 0.04, this is 0.12. This whole thing has to be 0.08. It's going to stay 8%. So the dividend yield will remain constant over its life. And if you solve for that, P subscript 1 will be $13.52. So all you want to do is set this equal to 0.08 and solve. You get $13.52. And well, let's see, we had a stock price initially at $13. That was P subscript 0. You multiply that by 4%, we get $13.52. It works because that's the price at time 1. And by the way, the math I'm showing you right here only applies to the constant dividend discount model. You cannot apply this formula to a two-stage growth model, for example, because growth is varying and the dividend yield will be varying. The math won't work. So this math only applies to a constant dividend discount model.